Hey, good morning, everyone. A great Friday to each and every one of you, and welcome to Rethinking Balance Sheets, the show where we talk a little bit about corporate finance related matters, but really try to position it in a way that makes sense to everybody. Ravi Navaratnam is joining me from Stage 3 Capital. Ravi, welcome to the show. And today's interesting, right? We're going to go into a slightly differentiated topic. We're going to talk about ESG investments and investing in ESG, which is really about environmental, social, and corporate governance. To some extent. And we're going to zoom in on the oil and gas industry and the impact on its balance sheet. So, Ravi, talk us through what we're going to talk about today.
Hey, Roshan, welcome back. I hope I know you had a good last Friday off doing something else.
Yeah.
Well, don't worry, we were well taken care of the last show. And we had a great show anyway. Today, Roshan, we've got two PhDs. Not usual. They've got actually two PhDs. Very, very smart people. Dr. Ken Pereira, which our firm has a long association with. In fact, one of our partners is on the board of that company, Dr. Rina. And we've done some work for Dr. Ken previously anyway. And we got Dr. Chen as well, Wei Nee, who's obviously very well versed with the topic of ESG. But just to come back on this thing about ESG, it's so important. It will affect the balance sheet. It will affect the financials. It will affect the performance of companies. I mean, I think that's we can come to that conclusion at the end of the show, perhaps. But that's my view, and I think Roshan, it's certainly I'm excited to have both these people on board today, and
we've got a crowd. And we've got a crowd actually. So we've got Proloy from India who says good morning. It's very early morning, I think, in India, Proloy. So welcome. I think we've got a bunch of people from Malaysia, from Singapore. Wax says happy everyone. I'm not sure what that means. Or how's everyone? Hey everyone. So welcome to the show. For those just tuning in, we're going to zoom in on environmental, social, and what we call corporate governance, or ESG, and we're going to zoom in on the oil and gas industry and its impact on the balance sheets. And we've got two great guests. Ravi, you want to shall we bring the guests on, or you going to say something else?
Let's bring them on.
All right, let's bring Dr. Kenneth Pereira. We've also got Pertal, who says hi guys. He's joined us. So as you join in, guys, feel free to put your comments there. We're happy to take questions, and in a second we will have Dr. Ken Pereira, and I see him joining us right now, and Dr. Wei Nee Chen, who's just joined us. Welcome, guys. I when I heard PhD, thinking the permanent head damage thing, but always good to have intellectually able people join us in our show in this intellectual discourse. Talk us through a little bit about, and I know both of you can just tune in and jump in at any point in time, but maybe the both of you can share a little bit about yourselves first, and then about ESG investing in general. I mean, your perspective of it. Maybe Dr. Ken Pereira, maybe you can start first. Just quick introduction to yourself, and maybe share a little bit on your thoughts on this whole space of ESG investing.
Yeah, thanks, Roshan. Thanks, Ravi, and thanks for having us both on your show. Yeah, I've just been an engineer in this business in the oil and gas business since I left university. So I've been nearly 35-40 years in the industry, and it's interesting. We've seen 4 or 5 cycles of changes in oil price, but in the last few years, I must say that and throughout my lifetime, renewables have always been in the background, but in the last 2 or 3 years, it's got to the foreground. So I would say it's now something that you cannot ignore as part of your business, and I think you have to really understand what ESG investors are wanting. You have to understand the whole concept of ESG, and which is one of the reasons, again, why we brought on board Dr. Wei Nee, or Wei Nee as we know her. And maybe Wei Nee, you'd like to introduce yourself, say a few words.
Hi, just to say thank you, first of all, to Roshan and Ravi for inviting us to this morning talk show, which I think is the topic is really getting a lot of importance and attention. And as Dr. Ken has mentioned, I'm actually new on board in Hibiscus. Yeah, basically I started off my life in the IT industry, spent more than about 15 years in New Zealand. Then when I come back here to Malaysia, I decided that I want to actually pivot my career to serve in the environment sector. So an opportunity actually avails to me that in the last 15 years, I actually served the Ministry of Energy in Putrajaya. under different capacities, but basically driving and promoting the renewable energy agenda in the electricity sector. So energy transition and climate change are topics that are very close to my heart. And I'm really very honored that Dr. Ken has actually invited me. Actually, it's a year already. Yeah, so this is going to be my first anniversary in Hibiscus. And it's going to be a very exciting era. We're talking about energy transition within the oil and gas sector. So definitely looking forward to this morning's conversation.
And talk us through this whole concept of ESG. I think for those who are new and listening in, I think Dr. Ken just mentioned a bit about what's this space about, and understanding this is critical. Maybe you can share a little bit, Dr. Chen, what ESG really means and the significance of it.
Yeah, I think of late, the ESG has become very important indicators, yeah, especially for investors, and in particular post the COVID. Once the COVID has really made us aware that the way we treat an environment is really what we deserve today. Yeah, so that's why we are looking at. I think for corporates, they have done exceptionally well in the G part of it for all their lives. But certainly with the COVID, it has actually highlighted that the E and the S is gaining importance. And specifically within the oil and gas sector, the environment part of it is very important. I think the environment part of it, for a long time, we have focused on a certain specific area, but the climate change has stand out in this COVID agenda. So maybe later on, I'm just going to stop here, but later on we can talk about how climate change and all these indicators impact the balance sheet. Maybe it's over to you, Ken, Dr. Ken.
Yeah, I guess I would just echo a little bit of what Winnie said. ESG, the G part has always been there. In the oil and gas, we always had HSSE. So it was health, security, safety, and E was just like stuck on the end. You had to take care of the planet when you were doing everything. But now it looks like the E has got to the front. It's E now, E, S, and G. So and within the social element, we also have to look at safety. So yeah, it's become a very, very, it's not evolving anymore. Actually, it's there right in front of our face. So we have to just address it and really address it seriously.
Yep. And our show is called Rethinking Balance Sheets, and obviously ESG is Ravi attuned to that ESG will have some of the impact on the balance sheet and potentially share valuation, right? Maybe you can share a little bit how does ESG have that impact, especially for those who may not be aware, and how can it potentially trigger valuation impact also?
Yeah, I think the share valuations are dependent on many factors. Obviously, you've had to always had a working business model. You've had to be in the right space. You've had to have analyst coverage. You've got to have a good board. You've got to. There have been so many elements. But just recently, what we see now is that when investors invest in you, they look at all your financial metrics. All of those have to be. You've got to tick all the boxes. You got to deliver good results. All of it. But then alongside it, they look into your sustainability report in detail, whereas before sustainability reports were kind of a add-on to your annual report, or and then it slowly became a small booklet on the side. Now the sustainability report is getting a lot of attention. You're having to put in a lot of information in there to kind of showcase what you're doing in the ESG space. People are taking that away and building it into indices like the FTSE for Good that Bursa has, for example. A lot of information from your sustainability report is built into a FTSE for Good index. And then based on the fact that if you're in that index, certain funds can come in and invest in your share. So I think it's becoming more and more important that we look into that all the ESG criteria. And many times, the serious funds give us a questionnaire telling us that you've got to also answer all of these questions about all your ESG indicators, because we have a separate framework as well. And if you don't answer these questions, it's all well and good you're on the index, but you also have to answer these questions for us. And some of these questionnaires, I mean, they go into 40, 50 questions. They're asking you all kinds of ratios. They're asking to make sure that stuff you're putting in the in the sustainability reports and all of it really bears out in your business. So we're seeing it in many areas, and the serious investors do have their own frameworks. So we're seeing it in valuations. Yes.
Maybe on that very interesting note, maybe if I just put a question, it's a little bit this one, but you're talking about sophisticated investors having their own questions and so on. But is there a simple index, if I'm a layman, that I can go and look at and say, hey, this company's got, just like like the ratings for debt and default, there's AAA, AA, and so on. Is there a simple index that somebody can go and look up for any company?
Yep. So in Malaysia, we have the FTSE for Good index. Winnie, you would like to provide some stats on that? For example, how many companies are on it?
No, but what would the ratings? Do they have some kind of rating, AAA, AA, or who's at the top?
Yeah. They've got 4-star, they've got 4-star, 3-star, 2-star, 1-star. So within the ratings, the index itself, there are different categories here. So thankfully, we work very hard at it. We've got a 4-star rating as a company. I just kind of give ourselves a bit of a plug there, but we work very hard at it.
Okay, I need to make a disclosure here. I'm a shareholder.
I think it's 4 stars out of 4 stars. We got to emphasize that. It's actually 4 stars out of 4 stars.
So it's 4 out of 4. Okay, so that's pretty good. Not 4 out of 5, right?
Yeah. Maybe. Yeah, just to add on to what Dr. Ken is saying, altogether we have nearly 900 public listed companies. Yeah. And out of that is only 763, and out of that is only 76 companies that's actually making it into the FTSE for Good categories. Yeah, and of course, out of these 76 companies, PLCs that made it to the FTSE for Good, we are actually in the top quarter percentile. So we are really very proud of these achievements. 4-star out of 4-star rating that's been conferred by the FTSE Russell and Bursa Malaysia. But I would like to also add on to the question that Roshan asked just now about how ESG impact on the balance sheet. And specifically, I would like to actually talk about how the climate change impact on the balance sheet. Yeah, because climate change, I think it has been, there's been a lot of noise on climate change, yet this particular subject matter with regards to how it impacts the financial part of it may not be so well known. So if there are some viewers out there, I think it's good to just give them a little bit of academic review on what is all this about. And I think with regards to climate change, what we are always talking about, if we look at, for example, the task force, the recommendations by the task force on climate-related financial disclosure, which is the TCFD. Basically, the TCFD actually talks about climate-related risks and opportunities. Yeah. So essentially, what happens is that the TCFD's recommendations for companies is that you evaluate your company's business against the different climate scenarios. Yeah, and they are talking about 2-degree scenarios, 1.5-degree scenarios. And on that, you come out with the climate-related risks and opportunities and how that impacts your balance sheet, income statement, and cash flow. So just to give you a very high-level overview, when we talk about risk, there are 2 types of risk. There's a transition risk, and as well as there's actually physical risk. So transition risk basically encompass like changes in the policy and legal, changes in the market and technology in terms of the demand and reputation of a company. And physical risks are attributed to the extreme weather events caused by shift in climate pattern, and basically how at the end of the day these can impact your balance sheet. And of course there are opportunities as well. We're not just looking at risks, and opportunities of course that can enhance your balance sheet. So I'll stop at that. Thank you.
Fantastic. We've got a quick comment from Robert Rao. And Robert sort of alludes that ESG is so crucial because apart from accounting and investment purposes, it also becomes a vital gauge for customers and buyers to evaluate suppliers' business sustainability risks. I mean, I think you guys would agree with that, right? The comment by that. And do you want to add to that, either of you?
I think for us, it is our buyers when we are selling our crude oil. What is becoming interesting is our crude oil off-takers are offering us green solutions to offtake the oil when they transport the oil and all of that. So obviously, further down our supply chain, people are looking at what we are doing and looking to see if they can add value to it. So yeah, I would say definitely we are in a commodity business, so maybe this comment a little bit less applicable to us, but definitely in the retail space, people are becoming more and more aware. I would say that, yes, I would agree with that comment.
Yep.
Just coming
Ravi?
back to the oil and gas sector, I think one of the things that I think many of us don't really get, if at least in Malaysia, don't actually get to invest in oil and gas sector. Most of them are just pure service companies. I think you're one of the unusual ones. You've actually got production assets. Yeah. Of course, we can't invest in Petronas directly. You can buy the bonds, but you can't invest in Petronas directly. Can you just tell us a little bit about how you look at your assets, impairments, and stuff like that? It's a large portion of your balance sheet, right?
Yes. So what we do to ensure that the balance sheet is represents the value of our assets is on a yearly basis we get what's called a competent person's report. A competent person will look at your assets. When we say assets, we are talking about oil in the ground. The oil in the ground is classified, let's say, in 3 buckets: what we call reserves. Then we have something called resources, and then we have prospective resources. So for our reserves, this is oil in the ground that is readily producible, can be readily monetized. Infrastructure is in place. You've got sales agreements in place. You've got offtake in place. You've got all the sanctions, all the approvals and permits required to produce, and that's the stream of cash flow. So those are your reserves. Then you have resources. Resources is oil in the ground that you have yet to get approvals on. So they would look at that as well, and they will risk it. They will say, what are the chances that you will get the permits, you will put in place the infrastructure, you will find the necessary investment. These might be certain steps or hurdles that you still have to kind of cross before you get before a resource becomes a reserve. And then, of course, you've got prospective resources, which are things that you kind of speculate might be in the ground and you need to do exploration. We don't do any of that now. So what we have is competent people, competent experts. They look at we use an international company. They look at our reserves and our resources. They put a value to it. They assess, they put a fair market value to that. And then they look at what we carry on our balance sheet. And if at any point, because the oil price, we use the oil price projections that the competent person would use. They would look at Brent futures. They would risk it a little bit, and they take a 10-15-year view on how things are looking. They would apply it, and then they would look to see what is the value of your asset versus your carrying value, and then they would decide whether it's impaired or not. And we do this annually, every year, for the presentation of our AFS, our audited financial statements at the end of the year. We are running through all of this process prior to that. Yeah.
So just for the benefit of everybody who may not be accountants out there, but you're still only carrying it at cost, right? You're not revaluing it upwards, right?
No, we don't. You're allowed, if you purchase an asset, if you acquire an asset, the MFRS allowed, to put it into the balance sheet, and you've got 1 year to get that number right. But after you do that, you just the chances are that you're just revaluing down if you impair.
That's right. Yeah.
We don't have a revaluation every year. No, we don't do that.
It's not like investment properties, which some people actually revalue all the time. So that's an important aspect of understanding the asset, that it could actually be much higher than the historical cost that the companies carry on the balance sheet. But just coming back on that wonderful issue of the index, I think that's the one that's interesting. Do you see a big change in more and more people on the fund side? We talked about the company side of it, but we also talked about there's the other side of investing, the investor. What's the investor looking for? And is it on the funds? Is it easier for them to go and raise money, or is it younger generation looking for companies which funds which are focused on 4-star companies, as you mentioned, etc. How do you see the trends, the flow of money itself? How do you see the flow of money?
We are not sure exactly how many of our investors are investing on the basis of the index alone. But what we know is when we have some serious investors who have a considerable size, or their investment is a considerable block of shares, and they would send us generally their own framework. They would ask us to answer a whole bunch of questions. Okay, so it's clear to us then that they have already identified that we are in the index, and then they have some clarification, or they have their own processes. So clearly, those are funds that require us to be to be ESG compliant in some way. So and we spend a lot of time doing this actually, and because these are the serious investors, to be able to carry on your register. So I think the index is a first filter, but the serious investors then will have their own qualitative framework. It is mostly qualitative. There are lots of essay writing you got to write and say what you actually do. They're not maybe they got concerned that your sustainability report is written by somebody else, so they want to make sure that the company itself can actually answer their questions. Okay.
I think perhaps, sorry, Ken.
Yeah, go ahead.
Yeah, I think what I want to add on to this is that the goalpost is also shifting.
Correct.
Yeah, I think as the issues on ESG, it's just gained a lot of significance. The goalpost is moving, and perhaps just to cite an example, even like for the FTSE for Good, the criteria is shifting. So we have just been informed that in order for us to be able to retain within being a constituent of the FTSE for Good, we need to at least meet some minimum climate change threshold. Yeah. So we also noticed that as we engage the analysts, the questions, they are slightly changing in format. Now they are asking whether do you have a net zero policy? Yeah, and then thereafter the next question would be, have you set your interim targets? So I think investors, they are stepping up their expectations, and you have also noticed that because of the COP26 that's happening actually by the end of next month, in Glasgow. So different governments are stepping up in terms of their financial disclosure. The UK government is talking about rolling up mandating the TCFD disclosure by companies in stages, and also definitely Singapore is looking to that by the end of 2023. So the goalpost is definitely shifting to protect the investors, and also to ensure that the sustainability agenda is not just a nice to have, but it's really a must to have.
Wow, fantastic. We just want to welcome a couple more people. Tyler Chin, welcome to the show. It says good morning. Anil joins us from Singapore. And for those of you who have questions or comments, please just shoot them in the comment section, and we will try to get to as many as possible. We have Dr. Kenneth Pereira, and we also have Dr. Wei Nee Chen, who's joining us today from Hibiscus Petroleum. And I think we have a comment or a question actually to the two of you. And the question is, since the ESG primary goal is towards net zero economy, and definitely oil and gas is a major player or gas player to this climate change agenda. What are oil and gas companies actually taking? Are they taking this as a challenge, and what's the plan for pivot, if there is a plan for pivot? Your thoughts?
Maybe I can start. Yeah. So we have been looking at what other oil and gas companies have been doing to see whether there is something that we can learn from them. And what we've noticed is this: many of the large oil and gas companies are uncertain which direction this whole energy transition is going to go. Okay, so we've read many reports which compare what the big oil companies are doing, and what we see is the oil companies are actually hedging. Actually, they're betting on many things. They're saying we'll do some solar, we'll do some wind, we'll do some hydrogen, we'll do some carbon capture. So they're actually uncertain where this whole thing is going to go. Okay, they're investing in technologies and all of it. So a lot of uncertainty out there. The only thing we seem to have, which is really cast in stone, are the targets. the route to get to the target seems to be still open. You know, there are many roads trying to get to Rome right now. So and people are trying all of these things, and it's clear that it's going to be a combination of many solutions that may hopefully get us to the target. Some of those solutions are going to be traditional with adaptation, and others are going to be maybe a little bit more radical, like things like hydrogen and ideas like that. So I think many of the oil companies, what we see is there's uncertainty in the which one is going to be the main route, but probably it's going to be a transition, and gas is going to be very much part of that transition. Winnie, anything to add?
Yes, I think first of all, before I move on to the energy transition discussion, I would like to just share with you a report released by DNV, actually very recently, I think in the last 2 weeks. And DNV actually did a projection about the future energy mix. So by 2050, fossil fuel would have dropped by 50% from today, yeah. And in particular, the biggest drop will be reflected in the coal sector, yeah, coal being the dirtiest among the fossil fuel. And then we see oil dropping to around 50%. And then gas, actually, for a while, it will peak because basically it replaces coal, yeah. Then after that, by 2050, it will decline by 24%. So as Dr. Ken has earlier on alluded to, gas will be very important in the energy transition. So I think this is where we'd like to share with you a little bit about Hibiscus Energy Transition, our strategy. So basically our energy transition strategy rests on 3 key pillars. The first key pillar is actually to create a resilient portfolio, yeah, of our hydrocarbon assets. And since gas is going to be very important in the future of the energy mix, we are looking to actually increase in our gas in our reserves here. And this is really reflected in our recent proposed acquisition of Repsol, in which half of the reserves are actually in natural gas. And why is gas important? I think maybe we can just briefly explain. Besides just replacing coal, we will also foresee that in the future, by 2050, IEA has projected that 90% of our electricity mix will be coming from renewables, of which 63% will be from solar and wind. And there's a lot of intermittent renewable powers that is going to be on board. So only gas at the moment is actually cost viable to manage this kind of intermittency. Then of course for gas, you can convert into blue hydrogen, which is another form of low carbon fuel. Our next pillar will be on decarbonizing our footprint, yeah. For that, we are actually looking at setting up interim targets and also, of course, our own decarbonizing roadmap. And of course, decarbonizing is already an ongoing initiative by Hibiscus. You know, just to share with you some examples. For example, in North Sabah, they have actually progressively shifted, you know, from fuel switching from diesel genset to a hybrid of solar as well as wind, mini wind turbine system. Yeah. So that has been ongoing, and of course, improving our operational efficiency, which will also improve our emissions. And then moving on, we are also looking at exploring carbon capture storage. That will be, we think, will be very important technology, because for any deep decarbonizing, even if you look at reports by the IEA, even the Paris Agreement, the UNFCCC, they're talking about carbon capture storage. And lastly, of course, we are looking into expanding the green investments, not just relying on the normal, our oil and gas business, but looking into how we can pivot into industries, especially within our close adjacent to what we are doing, and being able to leverage on our existing capabilities. So I've spoken a lot, and I think I'll stop here.
Well, thanks. We've got just take one more comment from James Lai. So James joins us. He says hello from the IoT Association in Malaysia, I think. And James' comment goes something like this. He said IoT will play an important role in ESG by providing real-time data from sensors, from predictive maintenance, discovering wastages, greenhouse gas emissions, asset monitoring, increasing productivity and yield, and carbon footprint. And I think it's a valid point that it is going to be a major change in our space. So, and for those who are just tuned in, we are talking to Dr. Kenneth Pereira and Dr. Wei Nee Chen. Please shoot your questions below. Ravi, I know you have a ton of questions, and I keep interrupting you, but go for it, Ravi.
Oh no worries. I think it's great to get questions from out there. But just to go back to Dr. Chen's question, remark earlier about the risk and this on that, there are actually indexes, or at least some indicators which tell you an investment has risks or opportunities. Again, that's something investors would be keen to understand. And what do these? Maybe you can elaborate a little more. You just touched on it a little bit, but if I'm investing and I take there's a scenario there is going to be a high increase in global temperatures, and what do these indicators tell us? Maybe you can just elaborate a little bit on that.
So yeah, I'm just going to take some simple examples. Let's say, for example, because there are two types of risks that we're talking about. One is a transition risk. The other is a physical risk. So if I give an example on a physical risk, as a result of increasing occurrence of extreme weather event or long-term pattern shift in terms of rising sea level, yeah. So all these could basically result in impacting your business operations or even your assets. Yeah, you could end up your asset not being, it could be stranded depending on location. So climate risks are basically very location specific. In fact, it's even your design of a system specific as well. Whether how your system is able to take the weather condition, the flood condition, the rising sea level condition. So all these will result in impacting your CapEx and your OpEx. It could result in increasing your OpEx. For example, if the weather pattern is going to be unfavorable, that actually moots the spread of more diseases. Like, for example, the COVID is one good example. Then it will increase your operations cost, which you need to price it in. Yeah. Then if I shift on to an example on a transition risk, yeah. So on a transition risk, if you look at the forecast in terms of the future energy mix, yeah, you can see that the clean energy space will increase, whereas the fossil fuel, the demand for it will decrease. So that poses a volumetric risk already. So everywhere around, people are concerned about whether are we going to end up with a stranded assets. Yeah. So there is a saying that the Stone Age did not stop because we ran out of stones. Yeah. And similarly in the energy transition, when we talk about all this transition, the fossil fuel industry will not disappear because we have actually run out of reserves. It's basically because the climate condition prohibits. So that's why the issue that we have here, Ravi and Roshan, is that we cannot pivot 100% into the clean energy space because the technologies that we have for today will not be able to bridge to the net zero. So therefore, the strong indication here with all the studies that we have is that fossil fuel are here to stay. So how can we actually coexist with fossil fuel and yet meet the climate agenda? So I'm going to stop here, and Dr. Ken, maybe you would like to give your opinion on this as well.
Yeah, well, there are opportunities also. You spoke about risks, and I like to really speak a little bit about the opportunities. Where we see opportunity is also the fact that more and more of the larger companies feel they need to take leadership roles in chasing the green agenda and the renewable space. But at the same time, during this transition period, there is also going to be a requirement for the current energy mix to continue to exist. So that gives companies like us a role to play, and maybe even a very long-term role. And what we see coming up in the near future is, in fact, the supply side of the oil and gas space may well tighten, because in the setting up of the green the green infrastructure, I would call it, there is even going to be more energy required to actually develop and establish that green infrastructure. So there is going to be, in our view, a tightening of supply and potentially, that is going to be an opportunity for the company to kind of leverage on that. So I think that is one of the opportunities that we see. The other opportunity, I would say, is being a lean operator. And having large companies exiting the business, there is an opportunity for us even to grow our business. So we just have to ensure that, like what Winnie said, the type of businesses we are looking at will have will not impact the environment too much. In other words, get into gas more than oil, etc., things like that. So I think that's what I'll add on to what Winnie has just said.
Just coming back to what you all were saying in terms of this one, I think the one thing that I've talked to a lot of the oil and gas companies is there's a frustration. The share prices are, I think, underwhelming, if that's the word. I mean, oil prices have recovered, and one of this, perennial concern is, climate change. But it's something like, I mean, the discounted rate of your cash flow is certainly nowhere near the share price. But how do we actually get people to start seeing it a little bit differently? And you talked about all these things about transition. It's going to be around there, but I think the perception is, oh no, oil is, because we hear so much on this media of green, global warming. I just think like oil is gone tomorrow. Yeah.
Well, let's put it this way. Our peers in the UK have seen a 30 to 40% increase in share price since the beginning of the year. Has the COVID vaccination rollout programs have got momentum. So maybe it's the fact that we are alone in our market. Maybe not many companies like ourselves covered in our market could be an issue. Could be the market itself. But what we know is our peers overseas have seen 30 to 40% increase across the board, actually, because of strengthening oil price, and in fact just the fact that people are projecting that demand is going to increase and prices are going to be strong, actually. So if you study it in London, you study the oil prices in the US, oil prices are share prices of oil companies have increased, have bounced back 30-40%.
Just for the benefit of our viewers out there, so that they actually have a better understanding of what you're saying, because I think when we talk about oil companies in Malaysia, most of them are the service sector companies, right? And they are struggling from the overcapacity, and which we had, and there's obviously lackluster in their performance. There's too much debt and so on, so that's being worked through slowly. But you're somewhat unique. What would be the peers that you would say in the UK that you look at?
I would call Enquest an exact peer, because they've got assets in Malaysia and the North Sea, exactly like what they would be a good comparison. There are other companies as well, but I always look at Enquest because Enquest are in Malaysia and the North Sea, and we are in Malaysia and in the North Sea, and they're about our size, but with a lot more debt, but about our size in terms of market capitalization.
Okay, you got me into a sweet topic there. You said debt, and we know Hibiscus doesn't borrow money, or virtually doesn't. Just tell us a little bit. I think we had Jim Ling here. She said she didn't charge you any money. That's what she told you for the fees for a job. We won't put you on the spot on that one. But just tell us your path through the SPAC from one of the few companies who's actually done that, the acquisition correctly and got into a listed company space, qualifying asset correctly. Just tell us a little bit about your path and the types of instruments you've got. You're funding all these oil assets on the other side of the balance sheet.
Okay, well, we started off life as a SPAC, and at that point in time there was no E&P company listed on the Bursa. So we came up with this idea. We looked at the options available to us. We had private equity offer us money, but private equity is always a case where each time you find a potential investment, you go back, they then talk to their LPs and they see whether they are able to raise the funds, and the target always moves. So we wanted to kind of be a little bit in control of our own destiny. So the motivation was, let's try and raise the money first and then look for an opportunity to spend it. And a SPAC provided us that type of structure. So once we kind of conceptually kind of landed on that, Malaysia was just about introducing the SPAC rules at that point in time. We devised a structure. Difficult thing was to find initially investors who believed in this type of shell company that just would have cash in it. But we managed to get that done, got it listed, and then found an acquisition and got that done. The important thing at that stage was, several SPACs have failed, and at that point in time, many SPACs had failed around the world. But we spent a lot of time studying why SPACs had failed overseas before we devised our structure. And we were also careful in the selection of shareholders. When we wrote out our prospectus, we even asked that we be given a waiver. In other words, even if we were oversubscribed in the SPAC listing process, the IPO process, we asked for the possibility to not accept all the, even if we were undersubscribed, we were asked that we not accept all the shareholders into the register. Because what we had learned is in different markets where SPACs had already been done, certain types of shareholders may be not good for your register if you're a SPAC. So we had learned that there were actually articles out by Harvard Business School and all of it as to why SPACs fail. So we studied all of that, and we asked actually for a waiver that even if we were undersubscribed, we wanted to be able to drop shareholders from being given shares. So we did that. We didn't have to do it because we didn't have the wrong profile of shareholders coming in. So we then listed. We got our acquisition away. The most difficult process in the whole SPAC process is what we call de-SPAC, come out of a SPAC into being a normal public listed company, finding the right acquisition, getting it across the line with the shareholders, etc. Along the way, we have made good investments, we've made bad investments, but overall, we are into our 10th year now, 2021. We are 10 years old as a company. So, and we are now on some producing assets. We have dealt with large companies. We bought assets from Exxon, Shell. We're recognized in the region as one of the serious players. So that's been the kind of journey we've had. In terms of debt, we've never really been able to get local debt because many of the banks here really don't understand so much the E&P business. They don't have in-house resources to evaluate E&P resources. So I think that's been a loss of opportunity for the local banks because I think it's a very big space. So then you rely on international banks, and international banks, we've had good relationships with them. Most of it is, most of their structures for debt in E&P companies is what's called reserves-based lending. And reserves-based lending means that you collateralize the oil you have in the ground. So the situation in Malaysia is that all oil in the ground belongs to Petronas. So reserves-based lending as a lending structure in Malaysia doesn't work because the oil in the ground belongs to Petronas. We as Hibiscus, for example, in Malaysia and all other contractors in Malaysia, we develop those resources on behalf of Petronas, and Petronas pay us for our services by giving us oil. That's the physical regime here. Overseas, it's slightly different. In the UK, the oil in the ground belongs to you. But in Malaysia, the oil in the ground belongs to Petronas until such time as they pay you for your services right at the end of the whole process. So you're not actually able to collateralize very much. So lending, borrowing money in Malaysia as an E&P company is not easy. You've got to work with sophisticated banks overseas who understand this type of thing. They're willing to take different collateral packages within the company. And that's the way you would access debt here. The other way, of course, is to issue bonds where you can collateralize maybe the shares of a company and give a kind of a general collateral package. So the opportunities for borrowing here as an E&P company, not so straightforward. I think that's what's not well understood. I think we will be doing some debt, I guess, in the future. But at this point in time, the company has been operating with minimal debt, minimum borrowing. We have used all key instruments.
Yeah. You have used other instruments, and how's that all worked out for you using RCPS and stuff like that? Yeah.
Yeah, so reasonably okay. We've managed to use our convertible redeemable preference shares. That concept, we've used it reasonably okay. I would say that we have very specific, when we're doing a RCPS or CRPS, we've got specific purpose for it. We have actually some instruments out in the market at the moment. We're not issuing right now, but all the shareholder approvals have been obtained. And for these instruments, we have a very specific purpose. It's for acquisitions. And if we're going to acquire something, we might need some equity. So we give shareholders the certain safeguards. The CRPS structure we set up is actually creating almost another spec within the spec. We get money we take money and we issue these instruments. And then if the transaction doesn't get done, we give it back with a certain interest, a premium, or alternatively, if the transaction does get done, we convert it to equity. So it's again like something like a SPAC.
Fantastic.
So that's the type of instrument we've been doing. But safeguards have been involved in, we give all the money that we collect under the CRPS is, for example, parked with a trust fund, and the trustee then has to get certain releases from a competent person to say all the conditions for the quality of the asset have been met.
Tremendous.
Great. Just quick question from James on I think it's a follow through from what he talked about earlier. Is specific to Hibiscus Petroleum, I guess. What are you guys doing in the adoption of IoT in your digital transformation journey, and what does that journey look like? I guess.
Okay, so maybe I'll take that. So I think there are two parts. There's a comment he made before that, and then there's a question. So the comment, a very interesting comment on instrumentation. We were talking about indices just now, FTSE for good and all of it. What we have seen is companies who want to, in this IoT space, who want to put instrumentation on our offshore platforms to measure the level of emissions so that they will not rely on the information we provide to them. They want to have an independent way of getting information direct from the source on the platforms and at the point of production, actually. And they want to be able to directly measure emissions so that they can provide independent reports to the people who want these, who develop these indices. They want to be able to provide the fact that, yes, emissions are reducing. These people are doing what they say. It's not just a reporting exercise in their annual report, who audits that report, etc. They want to have direct access to the acquisition of data at the point of production. So we have seen companies have approached us to see whether we'd like to work with them on such initiatives. But like I said, in Malaysia, we take the lead from the regulator, whether we are allowed to put such equipment offshore, etc. On the question of adopting IoT, what I would say is we look more and more at unmanned platforms for more efficiency. In other words, for example, our 20 platforms offshore Sabah, 19 of them are unmanned. So a lot of data transmission from the platforms that are working back to the mother platform, and so that we know when things break down remotely, we can send out a team who are then able to address the issue. So it may not. These are the, let's say, older generation of automation. It's more SCADA based. What we call SCADA based. It's digital acquisition of digital information and all of it. Not yet quite upgraded to what they call the IoT 5G space and all of it, but definitely on our agenda, because IoT increases efficiency, of course, and we are in the business of increasing efficiency. As Winnie said just now, when you increase efficiency, you actually you get a fantastic spin-off. You also reduce your carbon emissions, actually. So your entire package is much improved, and we definitely buy into that. There's lots going on. There's lots going on in this area.
Yep. Fantastic. Great to hear that. And this year is the 10th anniversary of Hibiscus. This conversation is like 50 minutes, just goes by really fast. Very exciting. And you can check out more details on Hibiscus Petroleum at hibiscuspetroleum.com. I want to close out by starting with Dr. Chen first. Your final thoughts. I mean, as we wrap up this topic and as we sort of synthesize it as some of the key takeaways, what is your sort of final thoughts and your sort of nuggets of wisdom that you want to leave with us as we close out today, Dr. Chen?
So I think what I'm going to leave with you today is basically more emphasizing again on the climate change agenda. So on that, I'm going to steal a quote from someone. It's not original from me, but the quote says that the earth has a deadline. Let us be that lifeline. So I've actually taken this extract from a keynote by Mr. Ravi Menon, who is the MD of the Monetary Authority of Singapore. He actually used this as an opening statement in his, good Financial Times investment conference 2 days ago. So I think that is a very important messaging, that we are actually living under a time constraint in order not to burst our carbon budget. And secondly, and also the final point to take away, is that ESG sustainability is at best a very muddled pathway. At the moment, we are looking at over 200 standards, reportings, frameworks, and there's an alphabet soup of methodologies out there which claims they all have their own claims on the ESG. And while we wait for some convergence on all these standards, reporting standards, I think we just have to move and forge along with our own ESG sustainability pathway. And learning, one of the fastest way is to learn from each another. So I think this kind of platforms that you are doing today is absolutely fantastic, whereby knowledge can be shared very quickly through a digital platform. And we can actually exchange ideas and learn from each another's mistakes along the way. Of course, not just mistakes, but what are the other salient points that help us to leapfrog. So I'll stop here and pass over to Dr. Ken.
Sure. Kenneth, Dr. Kenneth, if there's your final thoughts, and then I'm going to get Ravi, maybe just a quick sort of takeaway from today, Dr. Kenneth Pereira, and then Ravi, your thoughts after this.
I think Winnie is focused on the E part of ESG. Let me focus a little bit on the G. I think it's becoming increasingly important for us to focus on the governance aspects of our business also. If we do not focus on the governance aspect of our business, and all of us collectively, in the country especially, we will end up with investors going elsewhere, whether it's because of lack of compliance to ESG but for me, the G part is very, very important, and I feel that that is something that is going to really be important in the next year or two, so that we attract investors into the country, into the market. We need to really work hard also on the G. So I think I would just leave it at that. So.
Well, thanks so much, Kenneth. And Ravi, your sort of final thoughts on today?
I think,
and maybe some key takeaways.
Yeah, I think if you just, I think we've all learned a lot. It's an eye opener on ESG, in terms of what the index constitutes, what's being done out there, and what people are beginning to look at. Also on the other side, on Hibiscus itself, what I've known for a while, but I think it just comes out so well. This is a company with really in the forefront of thinking and doing things. And I think the word I use when I describe the show, trailblazers, I think that's spot on still as a description for them.
Fabulous. And guys, it's been a really exciting for those of you, if you have any more questions, just shoot them on, and we will try to get, and I see a couple of thumbs up coming. Thanks, Magdalena gives us a thumbs up, and a couple other comments are coming in. Thank you so much. It's been an exciting, if we don't focus on the governance aspect, investors will go elsewhere. So we're going to leave you with that quote. We're going to end, as always, with a short little video on Necole, and we want to thank Necole for bringing this show to the screen for us. And Dr. Ken Pereira, we need thank you so much for your time and your availability and for enlightening us in a pretty challenging space of ESG. Ravi, any closing words as we wrap today up?
Well, look forward to seeing you all next week. Another exciting show.
All right. Blessed Friday, everyone, and have a fabulous weekend. With that, goodbye.
What I found out,
Thank you.
I just gentle guy. I just discovered this new learning platform they call Necole. Man, that's the real deal. I tell you, man. I just pay only $50 for 1 year subscription, and my life don't change. I don't use that how much job for this content. I tell you so. You don't believe me? I tell you. I've been saying the link after I finish this call, guy. You remember when I tell you say to learn 8 hours a day for class, they tire me. This is the real solution for me right now because I learn in bite sizes at my own time, any place, anywhere where I want to learn. And if you get content across the board, oh boy, no be paper. I tell you now the real deal with this. Okay, no, I go send you the link. No, I go send you the link. We go talk later. I want the Necole my to go. Yeah, I go to Necole. I don't tell you now. I'm gonna tell you. Go sign up. No waste time. The link now digitaldynamics.org. Okay, we go chat later, babe. Okay, I have to go back. Bye bye. I'm on this Necole now the deal. Oh boy, I'm going to Necole to go. Easy.